Hello, this is PJ Denuzzo with Denuzzo Wealth Management for a Denuzzo Insight Contemporary Finance Update regarding the coronavirus and capital markets. Thank you for listening in today. First, I'd like to start off with being in gratitude and just to take a pause and be grateful for all that we have and all that the more we think, the more we would be grateful for thinking all that we have. And just to start off and just being in a right frame of mind and in a positive mood and praying for those who we love and those close to us. I would start off with at the very beginning of this, I received a phone call from the Pittsburgh Post-Gazette from the head business writer. And he asked me at the very beginning when things started to hit the fan and the coronavirus for a quote regarding the coronavirus situation. And I think what I had talked with Tim about was as pertinent today as it was at the beginning a number of weeks ago. And we've looked at this as a violent collision of the coronavirus and emotions. And of course, the key word is emotions versus economies around the world, GDPs, company profits, and the earnings of those companies. At the end of the day, for over 100 years, the stock market has priced companies based on their individual earnings and the projection for those earnings going forward. And that's really the collision and the tug of war that's going on right now. There still is a degree of uncertainty regarding the effects of the coronavirus and how that is going to affect, again, overall countries and economies, their GDP, the companies that make up their GDP, and the profits for those individual companies. I'll be giving you some more information on that in just a little bit. It harkens us back to a quote that's been used many times. Warren Buffett, who a lot of you would recognize Warren Buffett's name, credited the majority or super majority of what he learned as an investor and to be successful from his professor in college and one of the most successful investors of all time, Benjamin Graham. Benjamin Graham, one of his top 5 famous quotes was that the capital markets and the stock market in a short period of time are a voting machine, yet over longer periods of time, they're a weighing machine. So in the capital markets, we've got underlying fundamentals of profits of companies. What is that PE, the price earnings level, going to be on those organizations? But there's an overarching umbrella, or however you want to think of it, of emotions over top of those underlying raw fundamentals. And it's that overlying umbrella of emotions that can cause things to overshoot or undershoot sometimes, and the market is still digesting that. Regarding turning on TV, I'd mentioned on the last video we'd sent out, if you turn on the stock channels or the media, it's basically akin to quote unquote experts on those shows yelling fire in a crowded theater. I'll get into some of the hedge fund comments in just a second. Now, these hedge fund managers are causing a lot of the volatility today. As I'm taping this from our home office in Beaver and sending it out, the majority of individual investors are still buying and holding. They're holding on very well, but the hedge funds are doing an excessive amount of trading, and along with their algorithms, with their algos, as they refer to it, are exacerbating these movements in the market. This too shall pass, but again, it's that voting machine in the short period of time versus the long-term weighing machine. You have to remember with these hedge fund managers, when you turn on the TV and listen to anyone trying to give a big splashy quote, and when they're on one of the stock channels, they're basically performing the oldest trick in their book, and that is to get on TV or provide a quote to the Wall Street Journal or some financial media and basically talk their book, as they refer to it. It's not surprising if they're talking up a position, they typically own that position. If they're talking down a position, they're typically short that position. And even in the broad market, I'm certain that there are individuals who are on these stock channels talking about something negative about the market, and they are shorting the market at the same time. If them being interviewed can help to move the market down a little bit more, it's putting more money in their pocket. These folks do not operate under a fiduciary standard. Under a fiduciary standard, quite the opposite. In light of the coronavirus, a couple of operational things I would like to mention. A lot of you have heard regarding the social distancing, shelter in place, et cetera, across the state of Pennsylvania by our governor, as well as our national government. We are moving to a virtual office strategy in the supermajority of what we do. We have about a dozen team members working from a dozen sites outside of the office. There's about a half a dozen wealth advisors who are working for from either an outside office or a home office. And this gives us great diversification as far as access for all these team members, for safety for them. We've got team members in 3 different states across all these locations. So we've got great diversification. We're starting on Thursday, March the 19th, to transition to our full virtual office. And the common sense is to keep the space, not having anyone physically walk into the office. We can do Zoom meetings with you or go-to meetings virtually. The advisors are on the phone with their clients throughout the day, obviously proactively reaching out. And of course, email is available. So everything is as normal, other than just no face-to-face meetings or no face-to-face interaction in the offices, which is common sense per the state of Pennsylvania and the federal government's recommendations that they've made to us and other businesses. I talked a little bit ago about the voting machine and the weighing machine. We would never make any projections, but it is up to us to inform our clients. We're paying attention to this on basically a minute-to-minute or hour-to-hour basis throughout the day, starting before the market opens, well past the market closing. And as of today, March the 19th, when I'm taping this for our clients, the most professional investment firms are still predicting basically right around a break even for the GDP this year in the United States, which is sort of phenomenal. We are looking at a second quarter potentially being negative in double digits, being negative more than 10%. They're looking at a third quarter, may be high single digits. But again, for this, our annual GDP, and again, I talked earlier about the national growth, companies making up our national economy, their individual profits, we still remain very confident, and I will be getting to our ultimate opinion at the end of the video. You may have heard me talk before that anytime we go into a market suppression, if it's a correction or if it's into a bear market of 20%, 25% or more, we've always used an analogy that's like if you're playing in your backyard or you're playing in someone's backyard and they have a swimming pool and you're playing with a beach ball, the further you suppress that beach ball full with air under the water, the higher it's going to pop up when it comes out. Now, we're not looking for a dollar for dollar commensurate rebound whenever we get into the quarter when the demand comes back into the system, but it is going to be a very significant snapback in our professional opinion, and going to be sooner rather than later. So as we talked before, we're the steady hand. We want you to stay on your plan. More communication with your lead wealth advisor is better than less communication. If you have something you're thinking about, if you heard a comment, if you heard an interview, reach out to your advisor. Again, our advisors are reaching out all day long. We're in maximum relationship management mode right now. Obviously, we're not able to meet face-to-face. We can have a Zoom meeting, a virtual meeting, but please reach out to your lead advisor with any questions that you have. I'd like to make another thought, to step back for a second, and we are literally all in this together. Let's all do what we can by pulling together. There's a number of things we can do. I think all of us have probably seen folks at maybe a large box store or at a supermarket who were behaving less than admirably. Let's think about helping our fellow citizens who do need help, and thinking especially it's nice to see that a lot of organizations are starting to try to set aside time first thing in the day for senior citizens. If anything that we can do to help them, there may be someone down the street, maybe they're living by themselves. It could help them to deliver something and drop it off at their front porch so that they would be able to come out and pick it up. But we're in full protection mode regarding social distancing, keeping ourselves at 6-foot minimums from other humans, sheltering in place, and self-imposed quarantine, so to speak. Obviously, there's a direct correlation. The higher you are at risk, the more you want to protect yourself until this blows over. I mentioned last time about things being personal. Both of my grandparents came over from Naples, Italy in their teens and late teens to the United States, worked in a steel mill in Midland, Pennsylvania for 40 some years. My grandfather, I still have extended relatives in the Naples area in Italy. Italy was one of the hardest hit countries with this. And I just remind clients that I'm sticking to the numbers and sticking to the economies of what's going on, but there still is a personal side, and we are as heartfelt as possible, but we want to deliver our best professional opinion to our clients as we're walking through this together. The conundrum, of course, that we all know is what's best to fight the coronavirus, the quarantine is the worst for the economy. It's the ultimate double-edged sword. We have to do what we have to do. We have to lock down as much as possible and to mollify the growth of the virus and to put a wet blanket on it, so to speak, so it gives us as much time to come out of this and dampens the curve that everyone's been talking about. So again, that is the conundrum, but the lesser of two evils. We definitely want to dampen the effects of the coronavirus as much as possible. We'll fix the economy later on. That's not an if, that's just a when it's going to come back. But first and foremost, it's our fellow citizens, our loved ones, our family, friends, relatives, and neighbors that we want to take care of from the coronavirus as well as possible. Of course, there'll be varying pockets of recovery throughout the United States. So just be careful for certain areas as far as recovery versus the percentage. Some areas will be harder hit than others. So we'll just be careful when the information is coming back to us. We talked at length last time about being very careful to anything that you listen to on TV, social media, etc. You know, we're clearly in our mind at the end, past the end of the beginning of what is arguably the fastest bear market in history. So if it feels like we got knocked off of our pegs a little bit, yes, this was a very, very fast bear market in just a number of weeks, going from a high to going down 25% in the market because of the emotional overlay. At our firm, and this is our professional opinion, this again was really inflamed by, there's some views are political, some are just the media making a big splash. The more egregious their comments are, the more incendiary that they are, the more views they're going to get. Again, we feel that we're well into this, and I'll be talking about that again in just a moment. The good news again is massive U.S. and international monetary and fiscal relief. So U.S. Federal Reserve, for example, on monetary side, our government on the fiscal relief. It's good to see both sides of the aisle coming together to work on this for what's in the best interest of the U.S. citizens. So that warms your heart to see them working together for these solutions and for the stimulus that they're working on to help us get back out of the coronavirus episode as soon as possible. Thank goodness from our perspective that we went into this from a very strong economy, record unemployment lows, strong GDP. Just thank goodness in retrospect, again, that we went into this from a very strong economic position. There's been a lot of questions and comments talking to clients and others, if you turn on the TV again, talking about the last large meltdown in 2008 versus this one in 2020. 2020, what we're going through right now is raw emotions and the unknown versus almost 180-degree difference. The most quantifiable thing on earth is the bond market. In 2008, it was a meltdown of our credit markets, of our bond market, and even down to our money markets. So it was a Wall Street-centric meltdown in 2008. And again, this is a external virus creating a lot of raw emotions that we're going through right now in 2020. So we've ended up somewhat in the same area. We're still a long ways to go from 07, 08, 09, but we've got to the same area emotionally on the roller coaster we're going through right now. Again, we stay away from projections or anything else, but we're looking at the market every day. And just to put this in some type of context and some type of reference and framing for you. And again, anyone's downside estimate, that in $1.50 will get you a cup of coffee. But from where we're at right now, around, as I'm taping this, we're around 2,300 on the S&P 500, 2,350 in that range. If you start to look at an S&P range of 2,000 to 2,200, you're talking about a significant drawdown. At 2,000, the world stock market, the aggregate market, if you held a basket of the world stocks being approximately 50% or a little bit over 50 in the US and 45 to 50 of international, again, down about 50%. Right now, as of today, that global basket is down, as the time I'm taping this, about 35%. In our professional opinion, we're a lot closer to the bottom than we are working through it. Again, you can't time anything, nor would you. But just from a perspective of going on record, and I will officially go on record that we never timed the market, but my position as Chief Investment Officer of Denuso Wealth Management is that this is easily one of the 6 best buying opportunities of my lifetime in the 62 years I've been on earth. There was 1973, 74, 82, 87, the meltdown in October of 87, 2002, October, November of 02, the market was down about 50%, the S&P from top to bottom. Of course, 08 and 09, and now 2020. So again, we can easily say that this is one of the best 6 buying opportunities of our lifetime with where we're at right now. We've been working with clients in a case-by-case basis, rebalancing, Roth IRA conversions, tax loss harvesting, or just having conversations around just a relationship management aspect. If we are putting any money to work, we would recommend, again, to have a paced approach where not all at once, but to layer that in over time. And that's a relative regarding how much money you're adding to your portfolio versus your overall liquid assets. Some clients have given us pretty nice sums of money, and we put it all in because relative to the overall portfolio, it was not an excessive amount of money. So again, we're looking to take advantage of this as much as humanly possible. We need to ride this out, stay on our plan, and we have all the confidence in the world that, again, it's not an if, it's just a when. I'd like to end. My book is going to be coming out shortly, and it's titled The 7 Keys to Investing Success. And the very first quote that I have in chapter 7, which is titled Emotions Management, which states that it's at least in a tie for the most important chapter of my book. I got one key quote that I just want to share with you. When you feel tempted, unsure, unsettled, anxious, or as though you have lost your investment philosophy anchor because you were exposed to media noise or some investment talking head, take a breath and review my mental health emotional checklist and ask yourself a few simple questions. 5 questions I have. So you're watching TV, you're reading something in social media, ask yourself these 5 questions. Does this individual I'm listening to manage money for a living? Is it a material amount of money? Do they have a public track record vis-a-vis an appropriate index benchmark? Is that track record longer than a decade or 2? And finally, is it a successful risk-adjusted track record? At first, you will be surprised that over 99% of the individuals that you see on TV, listen to on the radio, have heard in social media, or read in print fail this simple checklist. After a while, you won't be surprised anymore. So again, caveat emptor, be careful what we're exposed to, what we're seeing and listening to. There's no fiduciary standard, basically speaking, that's included in any of that. We have your family, your goals and objectives, everything that's unique to you, your loved ones, and the causes you care for at heart when we're providing advice to you. I thank you for listening in today, and we look forward to talking with you soon. This is PJ Denuzzo from Denuzzo Wealth Management. Thank you very much.